Hi, accounting class. It's another great day to do some accounting. Today we're here in chapter 5, which is accounting for a merchandising business. A merchandising business is something like Target, Walmart, a lot of stores that we go to, grocery stores. They sell products. So instead of just services, we're going to sell products. When you sell products, you have inventory. So this chapter is going to get into mostly dealing with the inventory aspect of a merchandising business and the different terminologies. It's generally considered a challenging chapter for introductory accounting students. So don't be surprised if you have to watch it a few times to understand the concepts here. There's a lot of new terminology in this chapter. But we're doing this though we're paws and claws. They're going to start selling pet food. We've already covered a service business. It provides only services. Most businesses are a mixture, so you don't have many pure service, many pure merchandising businesses. They're usually a mixture, and Paws and Claws is also a mixture because they provide services, veterinarian and grooming services. But now they're going to start selling pet food, which makes them a merchandising business. Merchandising business is one that sells a product. Hopefully they sell it at a higher price than they buy it, therefore they earn a profit, they keep their shareholders happy, etc. So they buy it at one price and sell it at a higher price. We're not going to talk about manufacturing business much in this course, but this is the third type. If you're talking about service business, merchandising business, and a manufacturing is the third type. But we're going to save a manufacturing business for accounting 2302. Alright, we're going to have some new accounts here. This is mostly a storyline, but we can go through it. Merchandising inventory. Merchandise inventory, this is an asset account. It represents the cost of inventory. So it's an asset account, cost of inventory on hand. This inventory is recorded at cost, the cost it took us to buy it, not the sales price that we plan to sell it for. Alright, whenever we buy merchandise inventory, it goes into this account called merchandise inventory. When we sell it to somebody, we no longer have it, and that expense has to go somewhere, so we're going to put it into a new account called cost of goods sold. So when we buy inventory, it's an asset on the balance sheet as merchandise inventory. When we sell it, it travels to cost of goods sold. This is an expense account. We're going to summarize all of them in a bit. So Paws and Claws buys their food from Skylar's Pet Food Incorporated. This company offers trade discounts, which are common in the industry. These trade discounts encourage early payment, so that's the purpose of Skylar's offering them. They just give you a percentage discount if you pay early. Alright, they also live in another city, so they have to ship the pet food that we order to us. When they ship it, they have to have shipping terms. There's two that we're going to cover, FOB shipping point, FOB destination. So this is when they ship the goods. We're going to have two different shipping terms to learn. We're going to deal with that on the next page, so we'll save it for then. It says pet owners are picky when it comes to what their pet eats. Generally, they offer some type of refund policy here. So if goods are returned to the business, it goes to this account, sales, returns, and allowances. It's a contra revenue or a negative revenue account. Alright, so merchandise inventory is an asset account. It's recorded at cost. So whenever we buy inventory from a vendor, it's recorded on the balance sheet at cost. Notice every inventory has two dollar figures assigned to it. It has the cost that we paid for it and the sales price that we hope to sell it or plan to sell it for. Cost of goods sold is an expense account. After we purchase the inventory from a vendor and then we resell it, that asset, that cost has to go somewhere, and it goes to this expense account. We no longer own it. We have to remove it out of merchandise inventory and move it to cost of goods sold whenever we sell merchandise. And again, it's at cost. It even has cost in its name. So both of these are at cost. Merchandise inventory when we buy the inventory, cost of goods sold when we sell the inventory. The next one, sales, returns, and sales discount are all going to be at the sales price. Sales is a revenue account. When we were talking about a service business, we use fees earned. When we're talking about a merchandising business, we're going to use the term sales. And again, this is going to be at hopefully the higher price, the sales price, not at the cost. We're going to record it at the sales price. Sales returns and allowances and sales discount, both these are contra revenue accounts, negative revenue accounts. Sales return, this is when someone returns merchandise to us. They bought it and then they returned it later. It goes into sales returns like a negative sales account. We're undoing the sale effectively. Sales discount, this is what we're talking about where they encourage early payments. This is also a contra revenue account. We're going to see that it's only a seller's account too. The buyer's not going to have this account. It's called sales discounts. Alright, delivery expense. If we are delivering the product, there is potential for it to be delivery expense. We're going to clarify the shipping terms on the next page, how to record them. This is considered a selling expense. It's an expense, but specifically a selling expense. The only reason they're paying delivery expense is to effectively help facilitate the sale. Yeah, keep in mind inventory has two values: the cost that we purchased the inventory for, and then the sales price which we plan to sell it for. Alright, the next page, we see this image here. This basically details these shipping terms. Alright, so what happened? We have a seller here. This is a graphic I made, but it's nice and simple. I know the squares are a little off, but it still runs. Alright, so we have a seller here in one city. We have a buyer here in another city. They're going to ship the goods from the seller to the buyer. Now, the question is, when did the goods stop being the sellers and when do they become the buyers? I.e., when does the title change hands? Because that's going to influence a few things. So when did the goods stop being the sellers and when did they become the buyers? The answer to that question is it depends on the shipping terms. So if the shipping terms are FOB shipping point, then the ownership travels to the other party, to the buyer, whenever it's loaded onto the truck. So as soon as the goods are loaded up onto the truck, then the ownership passes. This is important for several reasons, but for us in accounting, it means that the buyer is going to be responsible for the shipping because it's their goods when it's in transit. Also, if you get into business law, it tells you like who owns the good. So if this truck got in an accident and lost its good, then who's responsible for that loss? Well, if the buyer owns it, it's their goods on the truck, so they would be responsible. But typically in this industry, everyone buys insurance, but it would be on the responsibility of the buyer to buy insurance for the truck. On the other hand, if we look at the other scenario, which is FOB destination, the ownership does not pass until the goods reach its destination. So until they're unloaded off the truck at the buyer's place. So the seller owns them and the seller will be responsible for the shipping under this scenario. So FOB shipping point, the buyer is responsible for the shipping. FOB destination, the seller is responsible for the shipping. Alright, so let's just get to the summary part here. FOB shipping point, the buyer's responsible. Alright, here's a tricky thing. When the buyer is responsible for paying that shipping cost, the only reason that they're paying that shipping cost is to get the inventory in place and ready to sell. As such, it's going to be recorded as an asset. It's going to be recorded to merchandise inventory. It's part of the cost of the inventory. Similarly, if you bought something online through Amazon and you had to pay shipping, that's really part of the cost of the product, right? It's part of getting that product in place and ready to use. So in accounting, the shipping cost that the buyer's responsible is part of the cost of the inventory. So notice we're going to debit the merchandise inventory account here whenever we purchase it. Whenever we pay for shipping, we got to pay cash to the shipping company. So we're going to see merchandise inventory being debited for the amount of the shipping and the cash being credited. This cost is said to be capitalized. Capitalized just means to be recorded as an asset. If the shipping terms are FOB destination, the seller is responsible. Now the seller's not going to debit merchandise inventory. They're selling that inventory. So they're going to debit delivery expense. This is a selling expense. The only reason the seller's paying that cost is to facilitate a sale. And of course, they got to pay cash to the shipping company to actually ship the goods. Why that one has 3. Alright, so those are shipping terms. The important thing is to remember from this page is this box. If it's FOB shipping point, the buyer is responsible, they debit merchandise inventory. If it's FOB destination, the seller is responsible, they debit delivery expense. Both of them credit cash to pay the shipping company. So if you can remember what's in this table, that's all we need to remember. Alright, inventory methods. One of these is periodic. We're not going to be looking much at periodic. Periodic means that the inventory records are updated only periodically. But now with the invention of computers and barcodes and how easy it is to get updated information, the most popular method is the perpetual method. Under the perpetual method, inventory records are continuously updated. This means it gives it real-time information to managers. And we're going to be focused solely on the perpetual method. We're not going to touch much on the periodic method. It may be an appendix later in chapters, but for our purposes, we're focusing on perpetual method. Alright, the next section deals with credit terms and trade discounts. So in this industry, like we said, vendors offer discounts if the purchasers pay within a certain period of time. They could say this long line. There's a 2% discount if you pay within 10 days, else the total without the discount is due within 30 days. But the industry doesn't want to type that many words, so they come up with a notation like this. Now these aren't division signs. If you're mathematically based, these are not division signs, they're just dashes. It says a 2% discount if it's paid within 10 days, else the net is due within 30 days. This is how we interpret this information, just exactly like it says up here. So just get used to translating this. The first number is the percentage. The next number is the days they have to pay within to get that percentage discount. And then the last part here just tells you the total amount of the bills due in 30 days. Even if you don't take the discount, you still need to pay us within 30 days. Alright, for example, a business purchased $10,000 of inventory on March 1st, credit terms of 2-10 and 30. I'm going to show you the math here. Alright, what we're going to do is take 10,000, the gross amount of the sale, and multiply it by 0.98. You're like, where does a 0.98 come from, right? Alright, so here's a shortcut mathematically. If we're taking a 2% discount or giving a 2% discount, either way, we're not paying 2% of the bill, we're going to pay the other 98%, right? So we take 100% minus the percent given, and it allows us to do this in one calculation. Alternatively, I could show you the other way to think about this. We could take 10,000 minus and parentheses 10,000 times 0.02. Alright, but first you had to respect the order of operations. You had to do the multiplication first. You'd have to calculate this. If you're on a simple calculator, you would have to calculate that and write the number down or remember it. Then you'd have to take 10,000 minus that number. That's why I prefer this, just taking 100% minus this number. It's a mathematical shortcut. It always works. Alright, how much will be paid if the buyer pays on March 31st? This is simple. 10,000, right? They have no discount, because they're outside of the discount window. The first one was inside. It was on March 9th. It was inside the discount window. The second one is beyond 10 days, so it's outside the discount window. Alright, trade discounts with the return. If you want the summary here, the most important thing is deduct the return before applying the discount. We're going to see if we don't apply this rule that we can effectively be scammed. I'll show you how to scam the business that doesn't do this, but all businesses do. Alright, this time assume that we had 10,000 of inventory sold on March 1st with credit terms of 2-10 and 30. But they returned 2,000 of the inventory on March 3rd. Alright, so how much will we have to pay if we pay the bill on March 10th? What we're going to do is take the gross amount of 10,000. We're going to back out the return because we had to deduct the return first. And then we're going to multiply it by 0.98 because of the 2% discount if they pay within 10 days, which they did on the first transaction. So notice, back out the return first. It's in parentheses. We have to do it first and then multiply it by the discount. The second one, you just got to back out the return. There's no discount because they're paying beyond the discount window. There's more than 10 days there. Alright, if we didn't, let's say we didn't back out the return. If we didn't back out the return, I'll just try to explain it. If we didn't back out the return here first, we'd give them a 2% discount on their gross price. Then they could return all the merchandise and keep that discount. Then they could buy merchandise take the discount, return it for the gross price, and keep keeping that 2% return and keep redoing this process and effectively scamming the business. That's why it's very important to deduct the return first before applying the discount. Alright, now we're going to start getting into the accounting side of this chapter. There are two methods we can use here. Either of these methods are equally appropriate. They actually get to the same ending point. They just get there in a different way. The two methods, one is the gross method and the other is the net method. Alright, so we're going to use the gross method in this chapter. It's kind of arbitrary. We can flip a coin which we're going to use. In this case we chose gross method. Either one works. There may be appendices with the net method. May not be yet. So this may not be true yet. I'll check. The gross method doesn't mean it's disgusting. Okay, that's just a joke. It's not called the gross method because it's disgusting. Gross, like your paychecks, you have a gross amount that you get, and then they take out all the deductions. You have a net amount that's lower. So gross just means before any deductions. It doesn't mean it's disgusting. Though, you might think it means this is pretty disgusting. We'll see. Alright, so this means we're not going to take out the discounts first because we're under the gross method. The net method would take out the discount initially. Alright, so assume a buyer purchased $20,000 of inventory with credit terms of 3-10 and 30. The date is 3/1. We purchase it. We're the buyer. It's very important in this chapter to keep in mind who you are. We're the buyer. We're purchasing merchandise inventory. And we owe somebody money. I know it's accounts payable because there's credit terms. If this was in cash, there would be no need for credit terms. So the existence of credit terms implies it's on account. We're the one buying the inventory, so we're going to be owing people. We're going to owe somebody money. And that's the gross method, so we're recording this at its gross price of $20,000. Alright, so that's the purchase. Next we're going to be looking at the payment. So we're still the buyer. We're going to pay the bill for the inventory that we purchased. We're going to pay the bill on two different dates to show you both. The first one's inside the discount window, so inside of 10 days. So I'm going to pay the full bill within 10 days. This is how I encourage you to think about it. Let's think. We're the buyer. We have to pay cash. So let's think about crediting cash to begin with. And we're not going to pay the full $20,000 within the discount period, right? Because we get a 3% discount. So we're going to take $20,000 times 0.97. We're only going to pay 97% of the bill. So we see the calculation there. The next thing I would think about is accounts payable. Once we pay somebody what we owe them, we no longer owe them that amount of money. So it's very important here for accounts payable to take it off in its full amount. If we didn't take it off in its full amount, if we only took it off for $19,400, we'd say that we still owed the other party $600, but we don't owe them $600. That $600 is a discount that we've earned by paying the bill early. So what we're going to do with that $600, let me make sure, some of these I put in the wrong side. This one's on the right side. Balances out. We're going to record, here's another tricky thing about this. Okay, so going back to inventory and the cost principle, we have to record inventory at cost. So we initially recorded this inventory at $20,000, but we didn't end up paying $20,000 for it. We only ended up paying $19,400 for it. So it is appropriate to mark down the inventory to be in compliance with the cost principle. I know this is a tricky one, but we're not sending back inventory at all. We're crediting inventory so that it's on our books not at $20,000 but at $19,400, the actual price we ended up paying for the goods, because we took a $600 discount. $600 does represent the amount of the discount, but it's recorded to merchandise inventory because we did end up paying the amount that we thought we were going to pay for the inventory, or the amount we initially recorded for the inventory. Alright, if we make the payment outside the discount window, this is pretty simple. The date will be 3/31 in this example. We don't have a discount, so we have to pay cash equal to $20,000, the gross amount, and we take AP off for $20,000. This is much simpler than the other one because there's no discount to deal with and no third account to think about. Alright, now we're going to look at a purchase and return of merchandise inventory. So the first one, assume a buyer purchases 20,000 of inventory with credit terms of 3-10. So we're doing the purchase under gross method. So we'll debit merchandise inventory, credit accounts payable. Alright, assume the buyer returns 4,000. So a return, just flip these two accounts around. So instead of merchandise inventory AP, do AP and merchandise inventory. A return is just the opposite of a purchase. So notice the relationship here. We just flip these two accounts around, and then it's a return. It undoes the purchase. Alright, now we're going to see the payment being made within the discount window and outside the discount window. Very important, once we have a return, that we subtract it out first. It'll be 20,000 minus 4,000. It'll be a total of 16,000. So let's do the payment within the discount period. We're going to pay cash. We're going to pay cash equal to the gross price of 20,000 minus the return, and then netted with discount times 0.97 to represent that 3% discount. So the gross price minus the 4,000 times 0.97. AP needs to come off at the amount it's on our books for. If we go back to the transaction, it was initially, AP was initially on our books for 20,000, but remember there was a return for 4,000. 20,000 minus 4,000 equals 16,000. We still have 16,000 on our books, so that's the amount we need to debit AP for to clear this transaction. All right, the difference here is 480 on the correct side. Again, we're the buyer, so this goes to merchandise inventory. It represents the 3% if you were going to calculate it. I'd just encourage you to save it for your last one. But if you were going to calculate it, this is how the calculation would look. Very important here to deduct the return before applying the discount. Alright, now assume that the buyer pays the full amount related to the March 1st transaction. Alright, this is outside the discount window, so we're going to be paying cash. It's basically going to be the 16,000, the amount of the initial gross purchase price minus the return. There's no discount to think about here. So we pay out the cash and we reduce AP by 16,000. The gross amount minus the discount. Alright, on the next page we're going to get to the seller. Alright, the seller, a basic sales transaction. It's going to be useful to get these four accounts in your memory. Whenever we sell something on account, we debit accounts receivable. We're going to credit the sales account, the revenue account. So this records the sales amount, and the sales amount of this is 20,000. But in addition, since we're under a perpetual inventory system, we also need to update our inventory. So this 16,000, the cost of this inventory needs to hit cost of goods sold, and then merchandise inventory. We have less inventory. Once we sell it, we no longer have it, so we need to credit the account to reflect that we have less inventory. So we see the four accounts here. It's just useful to get these four in your mind. Every time there's a sell by the seller, it's AR, sales, cost of goods sold, merchandise inventory. AR, sales, cost of goods sold, merchandise inventory. AR, sales, cost of goods sold, merchandise inventory. Alright, we're going to make a sell inside the discount period. Here we're the buyer, so we're going to be receiving cash. So we will debit cash. Debit cash for how much cash? Alright, it'll be 20,000 minus the discount. The gross amount minus the discount. Because they paid within the discount period, they've earned that 3% discount. So we're not going to receive 3% of it, but we'll receive the other 97%. In this case, we have accounts receivable. We need to take accounts receivable off of our books. Accounts receivable, it's on our books now for 20,000. We need to take it off for 20,000. Now we're going to have a remaining amount. Yeah, this one's the one on the wrong side. Don't write that. Put it over here. Notice the total debits and total credits have to equal. Alright, now we're the seller. The seller has to do something with this. This is for the seller, it's called a sales discount. Remember, the buyer, we hit merchandise inventory for that discount amount because it reduced the cost of the inventory. But for the seller, we're not going to hit merchandise inventory. They're selling that inventory. It wouldn't make sense to have any costs associated with it. We're going to record it to an account called sales discount. Remember, this is a contra revenue account. So the third account for the buyer is merchandise inventory. The third account for the seller is sales discount. Alright, if payment's outside the discount window, we just need to receive the cash and mark down AR. So receive the cash of $20,000, mark down AR. There's no discount, so both the numbers are at $20,000, the gross price. It's outside the discount window. They didn't earn the discount. Alright, now we're going to see a return for the seller. So the initial thing is a sale, so it's going to be AR sales, cost of goods sold, merchandise, inventory, right? That's why it's just useful to get in your mind. Every time there's a sale, it's for a seller, it's these four accounts. The gross amount is for $20,000. The sales price is for $20,000. The cost of the inventory was $16,000. Alright, now we're going to have a return. A return for a seller is very similar. We're going to flip around these four accounts and there's going to be one name change. Instead of calling it just sales, we're going to call it sales, returns, and allowances. So just imagine, I skipped a line for some reason. These two are flipped around and we're renaming sales to be sales, returns, and allowances. So you see it's basically flipped around except sales is renamed sales, returns, and allowances. The next two are a direct flip, so we just have merchandise inventory and then cost of goods sold. This is for the amounts they give us here. The sales price that was returned is $4,000 and the cost of the inventory that was returned of $3,000. So that's a return for the seller. It's pretty much just flipping all the accounts except renaming sales to be sales, returns, and allowances. Alright, now we're going to deal with the payments. If we're the seller, we're going to receive the payment. We're going to receive cash. The only important thing here is to mark down the return first, subtract the return first. Notice it was initially $20,000, but they returned $4,000 of it, and then times 0.97. We need to mark down AR for the full amount after the return, so it'll be $20,000 minus $4,000. We just don't consider the discount here. We need to get all $16,000 because it's going to be left at $16,000. Let me show you. $20,000 here and $4,000 here. So AR is on our books at a net amount of $16,000 if you subtract these two. So we need to take it off. Otherwise, it would show that they still owe us money. It would still be calling them up, and they don't still owe us money. Alright, the next one, we are the seller. So it's going to go to sales discounts. Tried to fix the border, but then it did that. Fix it later. Alright. We're the seller now. We're receiving payment outside the discount window. So now it's just get that $16,000, the gross amount of the sale. It's on 331. So we started off with $20,000, but they returned $4,000, so it's only a $16,000, and it's going to be we're going to be receiving cash because we're the seller, and we're going to mark down AR by $20,000. There's no discount, so this one is simpler than the other preceding one. Alright, the next thing, we're moving on to a multi-step income statement. In the previous chapter, we saw something called a single-step income statement where they just calculate total revenues, calculate total expenses, subtract the two, and you get to net income. Here we're going to be using one for a merchandising business. We're going to define a few terms. First, net sales is sales minus the two contra sales accounts. So sales minus sales returns and allowances and sales discounts. Gross profit then is going to be our net sales minus our cost of goods sold. This is often the most expensive, the highest expense for a business, a merchandising business. So we subtract it out first, get to something called gross profit. And then we take out the other expenses, the operating expenses, which includes selling and administrative expenses to get to net income. Should be gross profit minus Alright, so we have sales here, 52,140. We had some returns of 2,607. We have net sales then of 54. Alright, so there's actually an error in here. This should be subtracted out of here. It should be 52,140 minus this number to get to the net sales. But let's go ahead and pretend like this is the correct number. So it should be, it would influence all the other numbers as well. I just noticed that error. I have to correct it on the image. So it should be 52,140 minus 2,607. It should be 49,553 here, and then it's going to influence this number and down on. Let's go and pretend it's right for now. I'll have to update this entire image, but this should be deducted, not added. It's currently being added. Once we have our net sales, we take out our cost of goods sold, which in this case is $33,370, and we arrive at gross profit of $18,770. The next step is to take out the operating expenses, selling expenses which are incurred due to any costs related to selling the product, and administrative expenses which are costs related to running the actual business. So once we have all our operating expenses, we take our total gross profit of $18,770, subtract the operating expenses, and we'll arrive at net income from operations. The last part here, they have other income and expenses. These other income and expenses don't relate to the primary purpose of the business. They're kind of miscellaneous in nature. So the income statement puts them down here. An income statement generally has most important things higher up in it and less important things lower on the income statement. So it's kind of de-emphasizing these two income and expenses because they don't relate to the primary purpose. They're not in the business of providing rent or incurring interest expense. So we see the other income and expenses, add or subtract those out to incorporate them into the final net income number. Alright, let's look at the workout problem. This is probably going to be most similar to any quiz or homework that you see. So it's just a set of transactions. We're going to record them for the buyer and for the seller. So the first one here, Skylar is a seller. They sell merchandise at $17,000 to Paws and Claws of credit terms. The cost of the merchandise is $15,000, and the goods are shipped FOB destination. As soon as you see FOB destination, your mind should think the seller's responsible. And the cost of that was $100. So for the buyer's receiving merchandise inventory and they owe someone money. So the gross method, we're recording it at the gross price of $17,000. So that's simply the transaction for the buyer. Debit merchandise inventory, credit AP. On the second, the responsible party, which is the seller, pays for the shipping. We're going to record the buyer first and then do the seller. So we'll save that for the seller. So we'll skip on to the 12th. They make a full payment related to the transaction on the March. Let's see, did they earn the discount or not? It looks like, let me see how I recorded this. Yeah, they did not. So on the 12th, this is beyond 10 days. If we take 10 days plus 1, that's 11 days. They would have to pay on 3-11. They didn't pay before 3-11. They just missed the discount. So when we record this, they don't get the discount, which makes this simple to record. We just take AP off for $17,000 and credit cash for $17,000. Alright, there's another sale here, $21,000. So on the 15th, it's going to be merchandise inventory and AP for $21,000. Alright, here FOB shipping point is the shipping terms. This is the buyer's responsible. Remember, when the buyer's responsible and they pay for the shipping, they debit merchandise inventory. So we'll see merchandise inventory being debited here for the shipping cost and cash being credited. On 3/18, they discover 3,000 of the pet food was expired. They return it for a full refund. So here's a buyer return. We're basically undoing part of this transaction. So it'll be AP and merchandise inventory for the reduced amount, the $3,000, the amount of the return that we've returned. Alright, now we make full payment. Let's see, we're the buyer, so we'll be paying out cash. So my third line will be cash. I'm going to show you the calculation down here, but what we're going to do is take out we're going to start with the gross price. We're going to take out the return, so it'll be 21,000 minus 3,000. And then we need to incorporate this discount, because in this case they did pay within 10 days, right? So 15 plus 10 is 25. Yes, they've earned the discount on this one. So it'll be 21,000 minus 3,000 times 0.97 to reflect 3% discount. Alright, there we see it for the buyer. The buyer is the easier one because they only have, every time they make a purchase, they only have 2 accounts, where the seller has 4 accounts. We're going to move on to the seller now. They sold goods worth $17,000 and they cost $15,000. So remember, our 4 transactions for the seller is AR, sales, cost of goods sold, merchandise, inventory. And we just use the amounts given in the problem. Here, the seller is responsible for that $100 shipping cost. When the seller is responsible for the shipping, they record it to delivery expense. So we'll see delivery expense and cash being paid to the shipping company. On the 12th, this is where we receive full payment for the transaction on March 1st. Remember, this one's outside the discount window. So they're just going to pay us the $17,000. So we'll receive cash of $17,000 and then mark down accounts receivable for $17,000. On the 15th, we make another sell. So it'll be AR, sales, cost of goods sold, merchandise, inventory. So these 4 are sell. And then the amount the sales price is $21,000. The cost of the goods that we sold were $18,000. So we just get those from the problem. On the 16th, the responsible party pays, but that's the buyer. We've recorded that under the buyer. The seller has no transaction for this because the buyer is responsible. On 18, there's a return. So let's remember how we handle a return. A return, we're basically going to flip these 4 accounts around, and we're going to rename sales to be sales, returns, and allowances. So sales, returns, and allowances, AR, and then merchandise inventory first, cost of goods sold second. So flip of the preceding transaction with that one name change. And they give us the amounts in the problem. The $3,000 is the sales price, and then the $2,000 is the cost. The last part, we have the payment. Here we're the seller, so we're going to be receiving cash. And it's going to be the same amount. You can recalculate this, but it's going to be the same amount because they're going to take the gross price minus the return of $3,000 times 0.97 to reflect the 3% discount that was given. We need to take AR off for its total amount. It's on our books now for $18,000. It started off at $21,000 and we took $3,000 off, so 21 minus 3 is 18. That leaves us with a remainder on the debit side equal to $540,000. And we're the seller, so we call it sales discounts. This is the discount they offered to encourage early payment. Last point I wouldn't worry too much about, but this, if the pet food was expired, the company they're receiving it back, Skylar, when there was a return, they shouldn't capitalize it. They should expense it because we shouldn't record inventory on our books that no longer has market value. So there's a principle in accounting GAAP principle called lower of cost or market, where we record it at the lower of cost or market. And if it's expired, it has 0 value, then it shouldn't be capitalized again. But for the quiz, if you do everything that's on here, you'll get the full credit. Alright, the next page is just the Chapter 5 summary, which gives you the most important thing on one page. You can see all the different transactions here, for the buyer and the seller, the different accounts that are hit. You have to get the numbers from the problem, but you can see the different accounts, the shipping terms. This is just the most important information to know. But that concludes our conversation here with the Chapter 5 lecture. Let me know if you have any questions, and I'll see you guys next time for Chapter 6. Alright, bye-bye.